All right, the next topic we're getting into is new tax legislation. The OBBBA, the One Big Beautiful Bill Act. So, again, I think trying to stay away from the political dynamic of this, let's talk about what it is, how this is impacting the planning that we do for you, the planning you should be doing for yourself, how you're going to work with your CPA. And so there's a bunch of changes here. There's a lot to cover. So let me just dive right in. So the key highlights, so the 2017 Tax Cuts and Jobs Act were made permanent. So this was what was passed in Trump's first term, and these were set to sunset in 2026, which basically meant that without Congress acting and the president signing it, that we were going to see a fairly massive increase in taxes in 2026 across the board. And a lot of that was going to be born, everyone was going to feel it, but as a percentage of income, the middle class was going to feel it even more. So it was really important to get this bill passed. We could certainly debate the ins and outs of things that maybe should have happened that didn't, or shouldn't have happened that did. But the reality is they're made permanent, so those are the laws we're going to live by here, and that's the planning that we're going to do as a firm to help guide you through this. So some of the things that have happened from a standard deduction and itemization changes. The standard deduction remains doubled and indexed for inflation. I think the most significant here is the SALT cap. So that's you can see as the third bullet point down. Basically, it increased from 40,000 from 10. So this is pretty significant. So what that means, it's state and local tax deduction. So if you live in California and you're a decent earner, you're likely between property taxes and California income are going to have, where your state and local taxes will be 20,000, 30,000, 40,000, 50,000, 100,000, just depending. And so that $10,000 cap really increased your tax liability. So there's now a $40,000 cap. Now, I will tell you that if you're a higher earner, so if you're in the top 1% of earners, which puts you above 600,000 in modified adjusted gross income, then your cap is actually 10,000. So that's the bad news. So this is going to have a big impact on the middle class, upper middle class, people making between, let's call it 150,000 and 500. If you're in that space, 150 to 500, this is for sure going to help you, especially if you're a homeowner, because you're getting this increase to 40K. So just more deductions essentially. But if you're above 600, bad news, you're not getting any help. We also looked to see if there's any Medicare premium surcharges. So if you're of Medicare age, at this time there were no changes to that. All right, now we're going to jump into some of the weeds, and I'm going to move through this pretty fast. These are certainly things that you can look up. If they apply to you, then this is something you'll want to dig into with your accountant as you go into your year-end planning. So there was some expanded family and age-related benefits. So a child tax credit increases. If you're above 400K, you phase out. You get some additional above-the-line charitable deductions. Not super significant, though, because it's only 1,000 to 2,000. One of the cool things they put in place for retirees is that if you're individual over age 65 and you're in the, let's say, middle income or lower, you're going to get an extra $6,000 deduction. So if you look at the chart we put together, I think the area we can focus on is right in the middle. It says new senior deduction. So if you qualify, if you do not phase out, if you're single, you're going to get an extra $6,000. If you're married, filing jointly, and only one of you is 65, you're going to get $6,000. If you're both 65, you're going to get an additional $12,000. So when you start equating that to what does that look like at a tax level, that could, at the higher level, both of you over 65 could be an additional $2,000 to $4,000 a year that's in your pocket. So that's definitely a nice benefit for those that are in the over age 65 category. This was the one I think, so there's some new deductions for tips and overtime. This is definitely one that was most celebrated, I would say. People were really excited about not paying tax on tips and overtimes. There's a bunch of rules here, and I think most people are not super pleased about how this played out, but there are some rules that we need to be aware of. So for tips, the max deduction is $25,000. This is based on a single earner, so $25,000. Depending on your filing status, you can see there's phase outs. So if you make over a certain amount, then you still have to pay tax on tips. Overtime, it has the same phase out thresholds, but it has more to do with whether you're single or joint filer. So essentially, what this means is that if you're a joint filer using this data, and you're up to $25,000 of overtime income will not be taxed as long as you're below the phase out limitation of 300K. So if you're above that, it begins phasing out. And so again, this is depending on where you fit in the income spectrum. This could have a pretty profound benefit and save some monies. So these are temporary though; they only apply to tax returns 25 to 28. And then you still have to pay Social Security tax, Medicare tax. It's only the federal income tax that's basically not taxable. And I guess they're going to have to report tips and overtime separately, so it's going to get a little bit more complicated for payroll systems. There's another account that was set up called a Trump account. Now, given that Trump is going to be president here for a couple more years, I would have preferred something a little bit more of like an America account. So that it was a little bit more neutral, because I don't want the name to turn people off as saying this is not I don't want to invest in this, because these are kind of cool vehicles that I wanted to share with you. These are brand new. There probably will be changes along the way, just like there has been in the past, like when the Roth IRA was first launched. There's been changes over the years, but essentially the Trump accounts, it stemmed off this idea of invest for America accounts. It was a couple venture capitalists that floated this idea out, and they got it passed. And so basically you can see all the specs here about what happens here. So basically the Treasury will fund $1,000 at the time of birth for children between basically January 25 through the end of 28. So it looks like this will be needed to be passed again to go on to people in 2029. So for this to carry on as a permanent plan, I think they're probably testing this. The annual contributions that can go in there by family or employers is $5,000 a year, so that's the cap. And then there is similar to like an IRA, so it's tax deferred. And there's no deductions for individuals. And basically, those are some of the details. And you can look on the right-hand side. We said, okay, for parents, employers, or relatives, no deduction. One of the cool things here for employers, the note I have there is possibly. So I think they're trying to get this so that if an employer decides, so let's just say as a firm, Vance Wealth says, we're going to put $1,000 into any of our employees' children's account if they qualify, right? And so we could fund that ideally as an employer, because I would be putting this in as a fringe benefit for the employee. That it would be great if that would be deductible. But right now it's possibly, that is still under review. So stay tuned more for that. One of the knocks on this is I just keep reading. They're like, oh, this is not very good. It's not going to do anything. But I ran some of the numbers. It's pretty crazy. Now, we know the benefit of compounding, so you bear with me on this example because I went out pretty far. And I said, so the initial investment is $1,000 at birth. Let's just assume you put in $1,000 a year until age 70. You got a nominal return, which means before inflation 10%, inflation rate 3%. And then we invested over a 70-year period. So the top result is that the value of that account, based on that math, would be worth just shy of $9 million. But inflation adjusted, it's $1.5 million. So that's the important thing, because we have to do it in essentially in today's dollars. So $1.5 million. But that's pretty significant, right? So if everybody, by the time they got to 70, had in today's dollars $1.5 million, that would be a pretty significant win for individuals. And not at a huge cost. Now, right now, the Treasury is not set to fund all that $1,000, so it would just be the Treasury to fund the $1,000 at birth, and it would be up to employers or relatives or family to do the other $1,000. And then you can see, I just said, hey, what if you compound to 60? You can see it's still a nice nest egg of nearly $800,000 in inflation-adjusted value. So, kind of a cool idea. We'll see how these take off. Again, I think an Invest in America or Invest for America accounts would have been a better name. Okay, new deductions. So there's also a provision put in place that up to $10,000 of auto loan interest deduction for American assembled new vehicles. And there you can see on here there is phase out. So if you're married filing jointly and you make over $200,000 or $250,000, you're fully phased out. This is kind of a cool feature here. It's obviously just subsidizing the U.S. auto market. But on new vehicles, depending on how much you make, you're going to be able to deduct some of that auto interest. Green incentives expiring. So you can see the residential solar credit ends after this year, and the EV credit expires September 30th. So if you're looking for getting some of these credits, you got to jump on them now. We're running out of time. All right, this next section is on small businesses. So If you're not a small business owner and you're looking at our chapters, you might want to just forward through this because it's going to get kind of technical. So I'm going to run through this. This is certainly something that we're going to be having individual conversations with our clients. A lot of these changes are affecting going forward on 2026. So it's important to be aware of them. But basically, they created some new thresholds for qualifying for QBI, which is qualified business income, which basically gives you you get a 20% deduction of your profit on your tax return. So it just lowers your taxable income, which is great. And then you can see there's different phase outs. And so they essentially widen the ranges of phase out. So effective 2026, if you're married filing jointly, your phase out begins at making income above 384,000 and it fully phases out at 534. So with these notes in mind, like we're excited because as you all know, we do tax strategy for clients and really help them with the planning side of things. And so with these thresholds, then we're going to really be doing our hardest to make sure our clients can maximize this out because the qualified business income deduction is really powerful, and we want to make sure that we take advantage of what we can. So areas where we can accelerate deductions, take other deductions, can be really critical, so that if we fall into these phase outs, that we can maybe get extra deductions to move us below, right? So again, the new rules apply for next year. And I'm sure there might be some changes, but it looks like this is going to be a permanent part of the code, which does benefit a lot of businesses. If you are a SSTB, which is a specified service trade business, which we are as a financial services firm, doctors are, then this phase out is what applies to you. If you're manufacturing, meaning you make stuff, whether it's you make cars or you make tubs or you make pipe or you do something, then you're not subject to these phase out and you get this 20% deduction across the board. Another component, so for businesses that are growing and spending a decent amount of money, there are some new rules around bonus depreciation in Section 179 on expensing. And so the OBBBA outcome is basically the bonus depreciation, which means to be able to accelerate the write-offs. It was phasing down. This year it was going to be set at 40%. Now it's permanently restored to 100%. So this gives us a lot more flexibility with planning. As many of you know, we are not big proponents of always take the bonus depreciation. It depends how high your taxes are and what tax bracket you're in. But this gives us flexibility to make the right decisions and really be more strategic here. And then you can see it increased this 179 deduction limit to 2.5 million. And then the phase out threshold at 4 million. So there's a lot more flexibility we have here, which is great because it gives us, as doing tax strategy, tax planning, it gives us just more flexibility and higher limits to make some more impactful decisions for most of our business owners. Next one here. So this is pivoting from small businesses. Now we're going to pivot into estate planning section. So the new part of the code, essentially, you can see all the notes here, but we just made it a permanent. This was set to expire. It's now a permanent part of the code, and you can see some of the. We'll just start with maybe the single exemption in 2024. The exemption was 13 million. So that means if your estate up to that 13 million was not taxable, over that it was taxable. 2025 it was right now at about 14, and then 2026 it's going to 15. So the math's really simple. So for 2026 and going forward, it's 15 if you're single. Married exemption is 30, and it's permanent and it's inflation adjusted, so these numbers will go up. Other thing we get a lot of questions about is the annual gift tax exclusion. So for 2025, the annual exclusion is $19,000 per recipient. Last year it was $18,000. So as a married couple, you can essentially give $38,000 per recipient without triggering gift tax reporting. And just to note, the amounts we have here on the estate planning, if you notice on the headline, it says lifetime gift and estate tax exemption. So while these levels are most of the time applied upon death, these can be used during your lifetime as gifts. And so that's where a lot of the planning that's going to be coming up for our clients is we know this is permanent, so we need to look at estates. These are larger estates, so we can start advising on how do we make the best decision given that this is now a permanent part of the tax code. And then just summarizing some big items we're going to be looking at. What are some of the planning opportunities around this? Obviously consider itemizing if the SALT cap increase or charitable giving puts you in the over the threshold. We're going to really want to review entity structure and tax elections for your pass-through businesses to make sure you're taking advantage of these different deductions like PTE and QBI. If you're in the market, you should act on green credits before the expiration. It's really important to review your estate plan because of the higher exemption amounts. Again, before we had a sunset risk, so people were delaying. So now that these are permanent, we should be looking back at our estate planning documents and make sure they're still relevant. And then bonus depreciation and QBI changes create room for year-end tax planning strategy sessions. And so that's going to be really important to us is, okay, looking at expenses for businesses, how do we help them maximize the appropriate deductions that make sense from a long-term tax perspective. But please ask your tax advisor, and we'll be coordinating with your tax advisor as well on how these would impact your specific situation. If you're new to Vance Wealth and you're just uncertain about what's happening with your tax strategy, your investment approach, or you just want a second opinion, we'll do a complimentary consultation. So please just reach out so that we can, we'll want to gather some documents, ask you some questions, and then we'll be able to give you a report that does a deep dive on your investments and your plan and give you some guidance, and maybe would be a good fit to help you on a go-forward basis. You can reach us, you can schedule an appointment, just go to vancewealth.com and you can schedule an appointment there, or you can call the office at 661-775-0950. Thank you very much. I hope you found our 2025 Midyear Economic and Market Update valuable. Again, please like and subscribe on the YouTube channel, and we're looking forward to reconnecting in the future on our next video. Thanks.